Are we live? Okay, we are live. I'm told we are live. Hello and welcome to the Mutual Fund Show right here on Bloomberg Quint. It's Wednesday, 12:30 p.m. Your appointment with me, wherein we try and tell you how you should invest in mutual funds and what can these investments do for you. Now, something that I do a number of times on the show, try and tell you what have mutual funds done in the past. History is no direct bearing on what the future can do, but it can teach us a lot. This is a representative example, not an exhaustive example, of what value of 1 lakh rupees in various asset classes would have done over the last 10 years. If you had invested the amount in a bank fixed deposit, it would roughly have given you about 1.8 lakh rupees. Real estate, 1.87. This is an amount invested in suburban Bombay. An underperforming mutual fund, 1.9 lakh, close to 2 lakh rupees. Gold, it's had a fairly decent last 10 years, would have done about 2.69 lakhs. And an outperforming mutual fund, 3.71 lakh rupees. So you can very well see that even an underperforming mutual fund has done better than the bank's fixed deposit, and an outperforming mutual fund has really overscored almost everything else. Look at the charts here, and safe to assume that the blue chart has really outperformed. The key out here though is that the blue verb actually underperformed for the first 1 year, and even from those levels it's gone up. So point to point the returns would have been higher, but I'm taking it from the start, which is from 2007. The returns have been substantially higher. So the point that we are trying to establish on the mutual fund show, almost every show, is that if you invest wisely in mutual funds, you can really make money. But the theme of today's show is that if you have other liabilities that you have to take care of, how can you combat those liabilities using mutual funds? You can use mutual funds to save for your future. Can you use mutual funds to repay some of the liabilities that you may have? Can you use mutual funds to offset the damage of interest costs that come in via various asset classes, notably housing loans? And to talk about that and more, with me, a very special guest, somebody from whom I learn a lot and have learned a lot over the last few years, Vijai Mantri, co-promoter of Buckfast, chief mentor as well. Vijay, thanks so much for taking the time out. We are interacting after how long? I think it's been what, two or 3 years?
Yeah, almost.
That we haven't had a chance to talk to. Yeah. So Vijay in his earlier role was a CEO of a very large asset management company, and now has ventured out into advising people on how you should manage your mutual fund investments. And the topic is an interesting one, Vijay. So let's take our viewers through why we had chosen this. Real estate. Most people own real estate. Most people buy real estate through EMIs. You are saying that people can actually repay their housing loans or manage the housing loan liability very well with a mutual fund. How is that possible?
See, anybody who buy, if you look at the balance sheet of a typical Indian household, the biggest component is actually mortgage loans for normal Indian investor. And most of the people, when they buy a house, they take loans, and people go broke buying houses.
Yes.
And the average tenure of housing loan is, say, close to 20 years. So if you have a 10 lakh rupees loan, on that 10 lakh rupees loan, if you look at data for last 20 years, the average interest rate has been close to 10.70 or close to 11% over last 20 years. So if you have a 10 lakh rupees housing loan, your EMI works out to close to 10,000 rupees.
Yeah.
So over a 20-year period, you are paying 24 lakh rupees back to the housing finance company.
Okay.
So on a loan of 10 lakh rupees, you are paying close to 2.5 times cash outflow to the housing finance company.
Over the 20-year period.
Over the 20-year periods.
Okay.
Now, that is a hit you are taking in a balance sheet, but in a hope that you have a shelter above your head and dream house is there.
Yeah.
But is there a method to recover this loan liability, the loan which you have taken, the interest which you are paying? Is there a method to take it back? So yes, there's a method to take it back. If you look at the 10,000 rupees EMI of you are paying to the housing finance company, and on that you are paying close to 11% interest rate. If you take part of that EMI and put that money into SIP, into mutual fund, suppose the mutual fund earn you the same rate of interest where the housing loan rate is, then you just need to put close to 1/3 of the amount of EMI and you recover.
No, let me just explain, try and understand this concept. So you are saying that if I have a housing loan and there is an interest component in my housing loan, I should use some amount of or some proportion of that money and invest in a systematic investment plan, and that will help me offset the interest cost. Is that what you're saying?
Exactly. You will not only offset, you can recover the entire principal as well as interest.
Okay.
So in the given illustration, suppose the housing loan runs at 11%, close to 11%,
right,
and your EMI is 10,000 rupees per month. You just
the
need
EMI is 10,000 because the housing loan is 10 lakh rupees.
Exactly.
Right.
So you just need to do a 30% and below 30% of that EMI amount. So you have a 10,000 rupees EMI and you have 2,800 rupees as a SIP over a 20-year period from 1st July to 1997 from 1st August 1997 till 31st July 2017, the 2,800 rupees SIP at 10.7% would deliver you same amount of 24 lakh rupees, 24 to 25 lakh rupees.
Wow. So here's the deal, viewers. What Vijay is saying is that if you had taken a housing loan of 10 lakh rupees over a 20-year time frame, which ended on the 1st of August or 31st of July, you would have had a total outgo of 24 lakh rupees. If you had invested 2,800 additionally in an SIP, wherein your total investment would be 6.72 lakh rupees if I'm not wrong, this is simply 2,800 multiplied by 12 months into 20 years, you would have gotten back 24 lakh rupees. So you actually recover the entire principal amount plus the interest amount that you're paying on the housing loan. Naturally, if your loan amount is higher, you probably have to invest higher. But this is on an expected return of 11%.
This is exactly on 10.7%, which 10. is the housing loan rate for last 20 years.
Okay.
The Nifty delivered much better performance than this.
Okay.
And the diversified equity mutual fund has done much better than that.
Let's talk about an underperforming fund first before we
we can absolutely. Yeah.
So Vijay, I've taken an example of a return equal to a fixed deposit. Let's say for whatever reason, bad luck or otherwise, the return is not 11%, the return is 9%. What happens then?
So even the return is 9%, even in that case, your SIP amount instead of 28% just become 36%. So instead of investing 2,800 rupees per month, you could have invested 3,600 rupees per month. And that 3,600 rupees for last 20 years, even at growing at 9% compounding effect, would deliver you 24 lakh rupees on.
Okay.
So even in an underperforming fund, even the fund which is substantially underperforming, you would have got this number.
Wow. And in case of an outperforming fund, a Nifty beating returns of 20%, the amount would substantially go down.
Absolutely. So if you look at, if you had an option of starting your SIP on 1st August 1997, there were 28 equity fund at that time.
Okay.
And average return of these 28 fund over the last 20 years through SIP route has been close to 20%.
Really?
Yes.
Wow.
So if you had invested equal amount in all 28 fund without even judging which is good or which is bad, you invested in every fund equal amount in 28 fund, you would have invested just around 30-40 rupees per fund.
Wow.
And then this would have delivered you close to 24 lakh rupees over a 20-year period.
No, let me try and absorb this. You are saying that I would have had to have an outflow of 24 lakh rupees, but in order to offset that outflow, I would have needed to make an additional investment of only 1.8 lakh rupees.
Absolutely, over 20-year periods.
Over 20 years.
Yes.
And I would have gotten back that entire 24 lakh rupees.
Absolutely.
This is the power of compounding.
This is the power of compounding. Exactly. This is the power of compounding. This is the power of investing in asset category which multiply your growth at higher rate of interest, and there's a power of staying for the long term.
Okay, power of staying for the long term as well. So this is why we are saying consider an SIP. Now the question, Vijay, is from here on what happens? Let's say there are people who are tuned in and are convinced that okay, this might be a nice way to do it. Invest a certain sum of an SIP into certain sum of your EMIs into an SIP over a period of 20 years, and let's try and see if we can repay that amount, and which is why the topic, how to repay home loans using mutual funds. What can an average investor do now? There are 2 or 3 reasons why I'm asking this question to you. One, 10 lakh rupee loans are passe. We don't get properties for 10 lakh rupees. 2, if I'm buying a property worth 50 lakhs, 75 lakhs, 1 crore rupees, I am broke. I don't have money to carry out. I mean, I have some money to pay the interest in the EMI and some money to carry on my household needs, my children, my daughter's education, so on and so forth. Where do I generate the money to invest in the SIP, which is additional over and above the money that I'm paying on the EMI.
Fully agree with you. Actually, a dream house is a one-room shot always, because almost all of us go broke when we buy houses. So that is a challenge you will face. But you also need to keep in mind the other investment people do beside investing in house. So they have a gold, they have a fixed deposit, they have tax-free bond, they have money in PPF, they have money in EPF. So forget about all that. So let's assume that you went broke when you're buying a house, you pare down your expenses and you cut down a lot of spending, and whatever saving pools you had, you invest the entire thing into housing, buy to house at that time.
Yes.
This is what we could say for 90% of the common people. So let's assume that you're not able to invest for 3 months, 3 years from now. Suppose you bought a house today, but for next 3 years you're not able to invest anything because your expenses are there and you can't save more money. So wait for 3 years. But after 3 years, again go back to the same calculation. You start investing 1/3 of your SIP amount, 1/3 of your EMI amount, and increase that by 6% per annum, just 6% per annum. So in the given case, 2,800 rupees, suppose we are starting from month 1, but I am saying don't start from month 1, wait for 3 years, because you don't have cash flows, monthly cash flow. After 3 years, you take 2,800 rupees, start investing SIP of 2,800 rupees, increase this by just 6% per annum. Same 10.7% over a 20-year period, you will have 24 lakh rupees.
Wow. So the increase of 6% is in order to make up for the 3 years lost time. And the 3 years we are losing because we obviously don't have the money to pay that right now.
Absolutely.
If you have the money, then naturally resort to this from day one.
Absolutely.
Okay. Now the question is, let's say I have the money. Let's say I want to invest. Let's say I'm convinced by this theory that if I have a housing loan, I should buy a mutual fund and try and offset the cost that I have. My question is, what funds? Because in 1997, there may be 28 funds and maybe relatively easy to choose. Now, there are this bunch of funds. How do I choose? How do I know which fund will give me those market-beating returns?
So I think you ask a very interesting question. If someone says identifying a stocks is difficult, actually identifying mutual fund is that much more difficult. So how does typical investor buy mutual funds? Either they buy looking at the rating from various people who does fund rating, or look at the historical return of the fund, or look at the brand of the fund. Right. These are 3 ways people look at buying mutual fund. But these are the historical data which have as much significance as any historical data would have. But if you have to look at where I need to invest for 20 years, I don't think there is any single fund house or fund manager or fund product which is good for 20 years. Because when you're looking at someone with a 20-year track record, then the person is already 45, 50. Now you have to invest the same person for next 20 years.
A bit of a stretch.
Is a bit of a stretch. And fund management, in spite of all the things we talk, is an individual skill-based game. Okay, any great country could have a great cricketing system, but still individual player bring its own flair when he plays the game. Similarly, individual fund manager brings his own flair to the table. So when you buy a SIP product, when you invest in a SIP product, invest right now whatever you think is the most appropriate, but review the portfolio every couple of years. So if the fund is not performing, you can take money out from that fund and start investing in another fund. But by the way, if someone has to look at investing today, the Buckfast does have a current recommendation list which comes out every 3 months. So one could look at those fund houses and keep reviewing the fund house on the basis of recommendation. People like us and many other people are doing.
Okay, so essentially something that we try and tell viewers a lot of times as well, that it is a specialized thing, and you will be served well if you indeed have a financial advisor. Could it be Buckfast? Could it be anybody else? You take your pick. We are anyways on the show presenting some of the finest minds that we believe are great financial advisors, but it might make sense for viewers to have a mutual fund advisor on board, because that person will be able to tell you how to allocate money in a proper fashion. Now we have a few questions, Vijay, if you don't mind.
Sure.
There are some live questions that are coming in. So Amita Lavanya is saying, I have taken a loan of 1 crore at the rate of 10%. How much I must SIP? I've told you the question verbatim. I know it's difficult to maybe...
No, I can answer. The first things you should do is start renegotiating a loan rate.
Okay.
Because 10% is not the rate currently.
Okay.
And if she's a woman, then I think, which by name looks like,
Yes.
then she will get a 0.25% lower.
Okay.
So current rate on housing loan are anything between 8.35 to 8.65.
Okay.
It's below sub 9%. 10% is not the rate, so she need to go and renegotiate.
Would this be free of cost for her?
Of
I know
course,
it's a mutual fund
of
show, but
course,
since we're on
of
the
course,
topic.
of course, of course.
Okay.
The housing finance company may ask for some amount, one-time payment of some amount, but her EMI, either EMI will reduce or the tenure of the loan will reduce. So first thing she need to do is that. So I'm just not a mutual fund guy, actually I'm a financial advisor. So the one thing she need to do. And the second question is that if 1 crore is her loan tenure, and let's assume that she's just if 10% is the rate, then she has not taken the loan right now. She has taken loan couple of years back.
Maybe, yes.
Then again follow the same formula, 1/3 of the amount, okay? Do SIP of that amount. So 1 crore she may be paying 1 lakh rupees as a EMI. She need to do 25 to 30,000 rupees SIP and increase it by 5 to 10% per annum over the next 20-year period. She will not regret at all.
Okay. Now I think Vijay Buckfast and Vijay Mantri have given us a list of the names as well. So those should be flashing on your screens as well. These are the names of mutual fund schemes. This is not exhaustive, I believe. Vijay Mantri and his team could well have newer names 6 months down the line, 12 months down the line. So the names may change depending on various parameters that I'm sure that they discuss.
Sure.
But at this point of time, it's an indicative list which we literally force Vijay Mantri to share with us, so that viewers can benefit. If you indeed don't have a financial advisor, don't intend to have one, then maybe this is a good list as a starting off point. And at some point of time, maybe contact Buckfast or some of the others to try and figure out what else can happen. Okay, Vijay, the other question that does come to mind is that a lot of people want to repay the housing loan faster. And I hear a lot of comments. I don't have a housing loan myself, so I don't know. But I hear a lot of comments from people who've taken loans that the interest amount is much higher in the first few months and years, and then it kind of goes on tapering down. So it's in my best interest to pay off the housing loan quicker as well. Would a simple formula be that if you have the cash flows, instead of paying it off, the housing loan which is at 8.5%, invest that money into a mutual fund scheme, because mutual funds would probably end up giving you better returns than the 8.35% housing loan that you've taken, on which you also enjoy some tax benefits. Is that an advisable model or no, not quite?
No, it is an advisable model, but we Indian with the mindset not having any debt, that is the mindset we have. The first debt people take is on the housing loan. So a lot of people think that as a burden, so they want to pay it off and just live happily ever after kind of thing. But invariably what happens when you pay one housing loan, you end up taking another housing loan. If that is not the case, then I think if you look at one of the most trusted financial intermediaries in the world is a bank. And the bank work on the arbitrage of borrowing lower and investing at the high rate of interest. As an individual, you get that comfort in housing loan.
Okay.
Suppose your housing loan which is running at sub 9%, and the mutual fund which could deliver anything between 12 to 15% tax-free return, then you use 3 to 6% arbitrage working in your favor. So if you're not broke, if you're not over leveraged, your housing loan, and you're feeling very comfortable that over a tenure of this loan through your monthly accrual of income you're able to repay, then don't try to repay it faster. Whatever cash flow you have, additional cash flow, invest in mutual fund. The housing loan will take care of itself, and the additional investment you will do, perhaps that kitty will be very, very significant over the next 5, 10, 20 years period.
I know this is not an acceptable model, but here's Vijay Mantri, one of the finest minds arguably, recommending that you may try this model if you're comfortable with your monthly earnings. Don't try and repay the loan. Instead, repay that money in a higher return yielding instrument like a mutual fund, and keep your interest, keep your housing loan, because that is coming at an interest rate of 8.35%, which is arguably amongst the lowest that any of the mutual fund schemes could give back. There are 3 or 4 other questions, Vijay, that we have limited time. I'm sure, please keep your questions coming, because even after the show is over, we'll request Vijay Mantri and his team to reply back to you on some of the doubts that you may have. But Mohit Jogani is asking about, he wants to take a loan of 45 lakh rupees. How much do I have to do an SIP for that? I think, Vijay, one, you want to come in here, but two, you might also want to say that it's not an either or. You have to pay the EMI, but you also do an SIP along with. Maybe you want to reply to
Exactly.
this
No,
question.
absolutely. Whenever you look at taking housing loan, people just go, full scale and then don't keep anything for saving. I don't think that is the right approach. And I meet a lot of people who say we have so much liability, we don't have any amount for saving. But I think you need to inculcate that habit. Anybody who's taking 45 lakh rupees loan or 1 crore rupees loan will have a discretionary spending. So you need to cut down a little bit on the discretionary spending. Even you start with a 10% of the EMI amount to start with, I think you should start with. Because the mutual fund returns are not linear. Like you invested and every month and every day you get 20% higher NAV and your corpus will grow. It is going like through this roller coaster ride. So unless you go through the ride for a couple of years, you'll not understand the significance of how to make money in this kind of market. So just to get the feel of it, anybody who's taking housing loan should do SIP.
Okay. Now, how comfortable are you with the rate of return that mutual funds will give over the next 10 years? I know it's a difficult question, but markets are at all-time highs. A lot of people would be wondering, जो 20 साल पहले हुआ है, which is 20% returns for some of these schemes, क्या ये अगले 20 साल में हो सकता है?
I think this is the most easiest question to answer, very honestly.
Okay.
If you ask me which fund will deliver over 20-year period is most difficult question to ask. If you ask about market, most difficult question to ask. So what will happen over the next 20 years? So just look back of what happened last 20 years. Last 20 years, the average inflation has been close to 7%. Average fixed return product delivered close to 9% return. So you take 9% for taxation, you got approximately 7% return in a fixed return product. Okay. The GDP growth expansion has been close to 7% over last 20 years. So 7 plus 7 is close to 14%. That is a kind of return Nifty had delivered over last 20-year period. So fixed return delivery is 7%, GDP expansion of 7% additional. So you got 14% return, and a good fund has done 5 to 6% more than that historically. So now we look back, now we look forward. So the return would come from GDP expansion plus you add inflation. So if your GDP expansion is going to be close to 7% over the next 20 years, inflation is going to be 2%, 3%, 4%, whatever the number, so that comes close to 10%. Then you add now 3 to 4% higher than that. So you're going to get anything between 12 to 15% tax-free return.
On an average?
On an average.
In a good mutual fund.
On a good mutual fund if you do through systematic investment plan, but the holding period has to be reasonably anything between 10 to 15% or 20% kind of thing. Then in that given situation, you're going to outperform your housing loan, you're going to outperform your fixed deposit, you're going to outperform gold, you're going to outperform real estate and almost any investment product with the benefit of diversified fund management team available to you and instant liquidity.
So, yeah, which is an important point. So you're saying the holding period should be above 10 years at least.
See, the longer is better because the power of compounding works in your favor when you go longer and longer and longer and longer.
Yeah, but the shortest time frame that you believe should be about 10 years.
The shortest time period is very interesting. It's very funny when people look at mutual fund, they ask for time period. In the asset category in which Indian feel very comfortable, they never ask for the time period. When you buy gold, it is liquid only when you're buying. You never think of selling it off. When you buy a house, you never think of selling it off. Why this sword on the mutual fund?
Sure.
If you have that kind of comfort and love and affection you've shown for gold and real estate, then mutual fund is a great product to invest.
Okay, so let's quickly recap what we've learned in this episode, and I just want to bring out this one plate, and which is the standard plate. Expected return of 11%. The idea of this show has been to tell you that you can repay your housing loan via SIPs. Essentially, knock off the damage that interest rates do when you're taking a housing loan. And Vijay, just one example. I don't want to go to the 9% example, nor do I want to go to the 20% example. We're sticking to the 11% example, which is a fair example. I think the returns will be higher than this, but let's stick with 11%. In a minute, can you explain what should investors do when they're taking a housing loan with an illustration of an SIP?
So, when you're looking at a housing loan, whatever housing loan you're taking, just make it a point, you invest up to 1/3 through SIP. So suppose your EMI is 10,000 rupees, try to invest up to 3,000 to 3,500 rupees in equity oriented mutual fund. There's a ballpark figure you can take.
Okay.
Or a 20-year period, this will outperform your housing loan very comfortably.
And if you don't have money, take a break of 3 years and then start investing?
Absolutely.
And a top-up rate of 6%.
Absolutely. Absolutely.
Okay, great. Vijay Mantri, thank you so much for taking the time out and giving us this wonderful illustration. I don't think I ever anticipated a thought or a show wherein we talk about how can people repay their housing loans through SIPs and not have any damage. It's been a wonderful eye-opener. Thanks much for taking the time out. And viewers, thanks for tuning in onto the Mutual Fund Show. Remember, you can send in your questions even after the show is over, and we'll request Vijay Mantri and his team at Buckfast to give responses to those questions over the course of the next 2 or 3 days. Thanks so much for watching. See you next Wednesday.